All right, guys, we're here with part two with Tobias Carlisle. Last time we got things a bit cut off, but this time we're way more set up, I hope. And I got a bunch of questions for Tobias. We just spent the last like 20 minutes talking about fighting, so we won't get to that in. That's for our next podcast. We're starting together. Tobias, welcome back.
Hey, thanks, Tony. Good to see you again.
Good to see you again. So Tobias, I had a couple of things after our last podcast. I talked with a friend of mine who actually, in my opinion, if out of everyone I know, if there was a guy that should be a value investor, it's him. He's 10,000 times smarter than me, and he has the best stomach for investing I've ever met. But he made way more money doing crypto back when he was like 16 years old till now, and like there's no getting him to move off this path now. But he was like, man, I loved the episode with Tobias. I hate that it got cut off so short. But I want you to tell some stuff from like a super beginner's perspective. Like, he's like, give him some questions from the beginner's perspective. I would love to hear. And I was like, that's actually a great idea. And actually, I consider myself a beginner, so it's some stuff I wanted to ask you. So first things first, the first question I had is, I want you to describe your process of, I know how you identify them, but we spoke about in the last one with the acquirers multiple. But when you start getting into your initial research and generally your research before you buy a stock, how is the process? Can you walk me through it? Like, are you reading the annual report, then going back reading other annual reports, just going through the financials? Like, how do you do it?
I'm largely quantitative and systematic, not entirely, but pretty close to that. And so the way that I got started was when I was 18 or something. A friend of mine said Warren Buffett is the richest man in the world. He's an insurance guy. I said, that's interesting, but I don't really care about. I'm never going to learn anything about insurance. And he said, no, go and read the letters. He explains what he does. And so I did that, and it was the first time that I saw that there was kind of a process to it, that there was some sort of method behind it. And the method was, as far as I could tell, and Buffett is different from other people in the sense that the first thing that he's trying to do is to not blow up. Like, I think that's the most important thing, because it's just investing is unlike, there are many things that are like this, but, life is like this. Fighting is like this. One of the reasons that I like watching it. Business is a little bit like this too, that there's a risk of ruin in it. You can lose, and you can lose everything. And so you've got to be careful, first of all, not to lose anything, because if you get taken to zero, then you can't come back from zero. So the first step is always to make sure that whatever I'm looking at doesn't have that risk of ruin in it. And you can find ruin in lots of different ways. Some business models just have ruin embedded in them. So, banking is kind of there's a way that you can go to zero overnight with a bank. Like, we've seen that with Silicon Valley Bank, and we've seen that with all these other banks. That doesn't mean that every bank has that in them, but banking as a category has it in there. And lots of financial companies are like that as well, where they're lending money out that is real, and they're trying to collect money in the future based on a promise. And yet the extent to which you get that money back is how good you are at assessing the risk. And as an investor, you're relying on somebody else to make those assessments. And they make mistakes all the time. Often it's because they lend too much to either one person or one category of people, and they just get too concentrated. So I make sure that the business model itself is just one that doesn't have that risk of ruin in it. And so I just eliminate all of those. And then I look for these things that are in their financial statements that you can, so I wrote a book called Quantitative Value with a PhD at Booth, which is a good quant school in the States. We went and looked at every bit of industry and academic research we could find that talked about how you find these things. So one of them is, a big one is fraud. There are lots of companies out there that it's hard to match up how they're making their money with how they say they're making their money, because they're reporting lots of accounting earnings, but there's no cash earnings backing it up. There's no cash there. It's all stuff that you can fake on an accounting basis and stuff that you can't replicate on a cash basis. Having said that, there are companies that will, so Parmalat is a very famous example where they had a big auditor, PwC, And they sent the PwC associate down to the bank that they had $1 billion in, so they said. And they asked the bank, can you give us a letter confirming that there's $1 billion in there? And the bank said, no problem. And then we went back. You go back and you look at the behaviour of the Parmalat Group as a whole, and they were missing these bullet payments on debt in other places when they supposedly had this $1 billion in an account. And it turns out that the bank was in on the fraud with them, and so the bank was prepared to give them a note. So there's a limit to how much you can protect yourself from these things. But often you find that all of these events happen together, that you get financial distress. So financial distress is just they're getting closer and closer to not being able to pay their debts as and when they fall due. They've got some liquidity problem, they've got a solvency problem, they've got too much debt, they've got earnings manipulation going on at the same time. So there are various statistical tests that you can look at to see how much they're gaming their earnings, overstating what they're doing, drawing on reserves, doing other things like that. And then financial distress, earnings manipulation, and fraud. I just throw them in a bucket together because you don't get earnings manipulation without financial distress. You don't get fraud without financial distress. Like these things, they all seem to go together. So I just eliminate the ones that have those red flags attached to them. So we've got eliminate bad business models, eliminate too much debt, eliminate all of these risks. And then you start thinking about, then I start going through, like, what are the positive things that we want? So I want to get as far away from the fraud and all of that stuff, and I go to the other end of the table. So I'm looking at, is this thing generating lots of cash? And then you look at what they do with that cash. Do they pay themselves really high salaries relative to what the company's earning? So you look at a lot of financial institutions, like half of their revenue goes in salaries, goes in perks. You look at some of the tech companies, like more than 100% of what they earn goes in salaries, like they're issuing share-based compensation to pay for themselves, and nothing's falling through to the shareholders on the bottom. So you want cash flow, like real cash flow coming into the business. You want that cash flow being used for something worthwhile in the business. And so what you want them doing is you want them reinvesting those cash flows at a higher rate of return than the market. And so you can see that the average return on invested capital for an S&P 500 company is 13.3%. That's very high. You can, an earnings, a savings account at the moment might give you 4 or 5 or 6%. 13.3% is great. And then to the extent that they're reinvesting and not getting those returns, and they should be returning that capital to shareholders. And so that capital either comes back as dividends or it comes back as share buybacks. And all of those things together give you a picture about what that sort of management's role in it. Like when the cash comes back in, what does management do? So I want no risk of zero, no financial ruin possibility at all. And then I want to see that they are actually generating good cash flows. And then I want to see what management does with those cash flows. And then I want to pay a price that will allow me to earn alongside management, alongside, earn comparably to what the business is earning. So if you pay too high a price for a really great business, you've also got this risk that you're not going to get, the business might go very well. So this happened lots of times in the last time around that we had a big tech run in 2000. You could see GE, Walmart, Microsoft. They were all great businesses. Maybe GE less so, but they were all businesses that were earning lots of money. But you were paying such a high price for them that you couldn't participate alongside the business as it took 10 or 15 years for them to work off their overvaluation. So that's my framework basically. I'm trying to understand the nature of the business. Is it a business that is, Nassim Taleb would call it fragile? Is it a business that it does really well for 6 or 7 years, and then in the 7th year or the 8th year it's a donut? Like that's the sort of thing that you want to avoid. You want to avoid things that have management that's sort of picking your pocket a little bit on the way through, and you want to find the ones where they're, Buffett would call it being a partner with you. So that's the framework basically. So I'm looking for no risk of ruin and reasonable prospects for the future. It doesn't have to be. I don't really need high growth. I don't need super high returns on invested capital, because a lot of that tends to be highly mean reverting. Like when companies earn too much money, it's either indicating that they're cyclicals at the top of their cycle, or that they're going to attract a whole lot of competition. So you have to be careful, I think, of the over earners a little bit too. So my strategy is I tend to buy things that are closer to the 13% return on invested capital, or even a little bit below, where I think they're closer to the bottom of their cycle, and that over time they'll earn more. You know that they're reasonably trustworthy because they've got a tidy balance sheet. They're doing good things with they're buying back stock when they get cheap. That's a good sign. Paying out dividends and sustaining that business. And that's my process. I try to get this holistic understanding of the company, the management, and I think you can tell that stuff from the financial statements. I don't think you really need to hear what management says, although it's good when management is explicit about it, but many, many times, management is explicit and then does something else. So I think the financial statements are the way to go.
So let's say I remember one investment you made that I was a bit shocked by, was you were invested in Domino's Pizza. And so when you made that investment, did it take you a week of reading up on it, or was it I see it, I got the financial statements, this makes perfect sense, let's go, I don't have to spend?
So I knew about and had followed Domino's for 6 or 7 years by that point. So I knew that they had, it had not been a great business, and then they had got a new manager in 6 or 7, maybe a little bit longer than that now, and they had sort of turned the corner, and they'd bought back stock when they were cheap. They'd turned the business into a return on invested capital machine, because that business is, they just hold the IP basically to the process, and then they have franchisees, and the franchisees pay back fees to Domino's. So what Domino's is the kind of, not a holding company, but it's something like the intellectual property holding company that sets the systems. And so that's how they're selling to the franchisees essentially, and the franchisees are delivering. If you go into a franchise, they tend to be a pretty small store, and they are just running as hard as they can in there and pumping out pizzas. It's chaos inside those stores because they're going so hard. They're working really, really hard. And that's how they're generating such high returns on invested capital, because it doesn't own a storefront, it doesn't own all of that stuff. And that I think is a very attractive model. And so you find that lots of the franchisees tend to be great businesses, provided that people like the end product, and they don't take too much. You don't want your franchisor to be taking too much from the franchisees. You want a reasonably fair split. So that's why Chick-fil-A, I think, is the ultimate model, because the people who run the Chick-fil-A stores, they get half of the profitability. They're charged a fee based on the equipment that's in there and a few other things, but they're getting half of the profitability once they cover their cost of capital. That, to me, is the perfect model. I'd be happy to be an operator in one of those stores, because I know that I'd be getting a pretty fair deal. And so I like the problem is the franchise isn't, you can't buy into it, but I like that model. And so I like the franchise model as a business model for an investor. And I like Domino's. I just know my kids love it. I know that everybody loves it. If I say Domino's to you, you know what I'm talking. Everybody knows it's a pizza. They've got great mind share. All those things together, it's hard to point to any one thing other than quantitatively they were way too cheap for what they were earning. And then there are all of these other parts of it that indicate that it should be sustainable into the future. It's not something that's going away. The reason I was able to buy into it is they got, we go through COVID, they over-earned in COVID, and then they had all of the inflationary pressure on the other side. And it's just that little wobble, when these things are priced to perfection, a little wobble often takes them down a lot. And that's often the best time to buy them, because, those inflationary pressures probably go away over time. It's still going to be a pretty good business. It's not that big. It was like a $14 or $15 billion enterprise when I took the position. The risk in it is it's got a little bit of debt. They've been building up debt as they do the buybacks and so on, but I think it's sustainable where it is. That would be the process for Domino's.
Okay. I'm actually segues great into something I wanted to bring up. So I I recently made an investment in Dole's. Do you know it's the banana company? The
Dolls.
yeah, Dole. It's a banana company. It's not only the banana, but it's the world's largest producers and distributors of bananas. I'll go through a quick example of my investments process. So I found it. Somebody posted it. I don't remember where it was. Somebody posted like a quick oh, this has great upside potential with limited downside. I kind of read their thesis and then I went through. And I looked through and it has like a 9.7 EV to EBIT, which is not super duper cheap, but it's selling right now for 13% under its book value. So I was like, oh, that protects me from the downside. And they're selling properties and they're getting better valuations on those properties that they have been selling than even that are stated in their financial statements. So already I see that, hey, even if this is going bad, it seems like they're able to sell for better than what it's on the book value. So I should keep my investment should be pretty safe, even if liquidation were to happen. They're down because their fresh vegetables division had like a contamination issue. And,
Perfect.
Yeah, perfect. Yeah.
That's the time to buy.
And people they lost I think 40, 50 billion or something on their earnings. 71 million a decline on their earnings or whatever from their EBITDA. Sorry, and so everyone started freaking out and it started dropping. And then somebody came and offered to buy, another company came and offered to buy the fresh vegetable division, and they offered to buy the fresh vegetable division for a higher EBITDA margin than the entire business is selling for. There's an entire business selling for like a 5.3 EBITDA margin, and they were trying to buy the worst part of this business for a higher EBITDA margin than, a higher EBITDA value multiple than the business is the worst part of the business. So I was like, well, has anyone ever tried to buy this business in the past? So I kind of looked into that, and somebody did try to buy it, and they paid 9 times EBITDA they were willing to pay. And I was like, well, we're at 5.3 times, so that's pretty good. And they're one of their competitors, one of their closest competitors right now is trading at 7.4 or 8.4. I wrote it down somewhere here. Around there, say 8.4 times the EBITDA, and I'm like, well, we have a pretty good upside here, considering that they're still earning, they're making money, it's agricultural industry, so there's always the risk of shit going completely catastrophic. But I was like, even worst case scenario goes down. So I did a quick look. It took me all in all 2 hours, like max, and I was like, man, I feel comfortable. Like I feel like it should be okay. It's pretty cheap. There's no that much downside. I felt kind of guilty. I only put a small position. I bought like 3% of my portfolio in it. I was like,
I think that's a pretty full position, but yeah.
Yeah. So,
I have smaller positions. I just like smaller positions.
Smaller, yeah. Because I'm super trying to figure out my process. But yeah, let's say but at that point, I'm trying to still figure out. I have my positions are bigger now. Some of my positions are 10% at this point in my portfolio. But I put that as a 3% position. What do you think about that as like a thought pattern? Do you see any flaws in that, or?
I think it's a good process. I think that's all of the risks, right? The problem with things that are grown is that there's always some possibility of there's droughts and there's whatever else goes on. So you have to normalize a little bit for that stuff. But the idea that you're buying it when it's beaten up, where you think the downside is very, very minimal. And you know that there are like multiple ways to win. They can sell off the properties, they can sell off the business, and it's a pretty stable kind of business. It's not like you got to predict out into the future. What the technology is going to do. Yeah. Bananas, like it's a pretty long history of people eating them. Yeah, I think that's a solid. I'd be happy to buy something on that basis. That's basically what I would be doing, and I think people. I have it. This is my own bias. I tend to not. I think 2 hours is probably enough for the most part. It depends a little bit on the business, but I think there's this idea that competence and confidence. The more information you hammer in about an idea it just makes you more confident that you're right, but it doesn't make the idea any more right. There's like this return to scale where the first 2 or 3 hours, many people disagree with that. There are big funds that will spend like $1 million on DD, and they'll call. And so there are lots of different ways of doing it. I'm just talking about my own particular bias. I think that you should be able to get there pretty quickly and understand what the problems are. And then if you think that there are key risks, then satisfy yourself about the key risks. But pretty early on, you know what's going on. And then after that, you're trying to kill the idea. And so if you're still like trying to hammer in that it's a good idea beyond the first sort of brief run through, you're kind of going about it the wrong way. Your idea should be, you like the idea, and then you spend the bulk of your time trying to kill the idea. And that's kind of my process. I like Domino's. I saw the valuation. I know the company. And then I go through that process of like, how are we going to die here? And like, the death from Domino's will come from having too much debt, but I think they can service it because it's a pretty stable business. But at some point, if it goes down, it'll be because of the debt. But I know how I'm going to lose it. Or, they get a little bit unlucky. Like Chipotle had a norovirus outbreak, which norovirus is the thing that takes down cruise ships. It's incredibly contagious. It goes from person to person. It's nothing to do with contaminated food. It's just, if I have norovirus, like kids get it all the time, adults get it all the time. Yeah. You get immunity for a couple of years, then you get it again in a couple of years' time. It's misery when you get it because it's gastro and nobody likes it. And people always think, when you get it, and you blame it on the last thing you've eaten because that's the thing that's coming back up. So they're awful when they happen. And so that's always a risk with food type things, that you get some outbreak like that. And then poor old Chipotle, like the press kept on reporting about the same outbreak as if it was a new outbreak. And it went on and on and on. And anytime, the regulator would say something or anybody would say something, it sounded like they were having this string of outbreaks, and they were saying that it was food contamination when, dude, it could just be some guy who's sick who comes into work. He's already sick, but he doesn't know, because it hasn't kind of catalyzed in his body, hasn't felt sick yet. But you're incredibly contagious before you actually feel sick, and that's when they're infecting everybody. But they're reporting that like it's there's something wrong with their food process, so the whole company gets sold off. So Chipotle was a good example. Like I think when you see them sell off for a reason like that, that's an opportunity, because you can now go in and have a look, and maybe you get it cheap, because those things get sorted out. They get resolved fast enough. So I think that was a good process.
All right, I like that. I think Bill Ackman bought Chipotle then when that happened, right? I think so. I'm not sure.
I mean, super high quality business, very well run, incredibly long reinvestment trail in front of it, like lots of opportunities to expand and grow and do other things. And they've got this, it's very fresh food, so it's different to like, McDonald's, they freeze everything. Chipotle's doing it all fresh, hard to do, and they were doing it really well. So there's lots of other places they can expand into, which they've done since. I didn't buy it at the time because I just couldn't get there on the valuation, but I had a close look at it at the time, and friends of mine did buy it, and they all did pretty well.
So that's actually a good way to lead into the next thing. So when you're working for the acquirers fund, do you have a team that works with you, or are you doing this all by yourself, basically?
So I outsource. There's different things going on. So there's the management of a 40-act company, a 40-act firm, which is what the ETF is. There's a lot of back-end administrative compliance work that needs to be done for that. I have various partners who they're not employees. I contract with them. They take care of all of that. So I have tried to reserve for myself the part of the business that I really like doing, which is picking the stocks. And I like talking about it. I like doing this sort of stuff, going around and talking to everybody about what I'm doing. So I do those two things. I run the portfolio. I have responsibilities for compliance and reporting and all of those sort of things, but all of that is prepared by somebody else, and I just ultimately have to sign off on it. And then because I'm quantitative mostly, and I have some other services so I pay for services that do deep dives into the businesses to find out if there's anything that the quant stuff would miss. So they do an analysis that takes in any of the notes and any of the other things. So that's kind of like having analysts who would do that work. I just pay a service that does it across a whole. They have the 30 analysts. I don't pay for the 30 analysts. I just pay for the output of it, and then I put that into my system. I put the output into my system because I have this view that I think that I don't trust other people's reportings. I don't trust my own mind. Basically, I don't trust anything. Like, I think if you're going to go down, it's probably going to be some mistake that you make. You just you fall in love with an idea, and all of this bad evidence starts piling up, and you just ignore it because part of being an investor is you have to be able to buy these things when everybody else says it's a bad idea. So you have to kind of get that mentality. But then the problem is with that kind of mentality, you might just be like, the chances are that the market's right and you're wrong. Like, that's probably what's happening. And here you are saying, no, I'm the one who's right. So I always think you have to accept the possibility or the probability that you're wrong. And so I spend a lot of time looking for the red flags and trying to kill the idea and reading the other side of, I'm like, as you say, like, it takes a couple of hours to get comfortable with an idea. And then beyond that, I go and read, why do people not like this? And sometimes their arguments are very persuasive. And I still think, you know what, because it's only a 3.3% position for me, I'll put it on and I'll see what happens, and I'll see if they can get their way out. Because the nature of this, what I think makes value work, is that there are expectations built into what the market is. Everybody's reading the same information, basically. There's nothing that's kind of hidden. Some people have better insights than others because they understand how industries work. But I think there's advantages to being a generalist too, and having a less of an industry-specific insight and more of a general insight. But hang on, I've just lost my train of thought. What was I saying then?
You're saying it was good to be you feel it's good to be a generalist sometimes instead of being an industry specialist.
Yeah, just before then, So there's expectations built into the way that a firm is earning, and that's based on all the historical stuff that's happened and where people expect the company to go in the future. And when the stock or the company defies those expectations, that's when you get the really big moves. So if a company is very good and it's priced very high, those are the expectations for the business. And if it stumbles, then it's defied those expectations and it'll have a big move down, and vice versa. If the expectations for the business are really bad and it does slightly better than they expect it to. And so this is something that my process is very simple. I'm looking at historical financial statements, and there's a big dislocation between what the historical financial statements say and what the future expectations for the business are. And I have to decide if the future expectations don't match those historical expectations, those historical facts, then the business is probably going to follow the expectations. It's just going to trade where it is. But if the historical financial statements are translated into the future, if it continues doing what it's doing and the market's expectations are really bad, then you're going to have that moment where it's defied the expectations of the market and it's going to have this huge step up. And that's deep value. That's what I love about deep value, that you get these happy surprises all the time. Like, something really bad happens to a dog shit company, the market kind of shrugs. It's like, yeah, that's what we thought was going to happen. But something good happens, they're like, oh, hang on, there's something going on here. Yeah. And you see these big re-ratings, and that's what I love about it. Because I've spent enough time on the other side trying to be more like a Buffett type investor, where you're trying to find the better companies, and I've had them stumble. And I think, they're already trading a little bit cheap, and they've stumbled, and it's because the market knows more than I do. I'd rather it just be around the other way, where the expectations are so bad that if something good can happen, then you have this big re-rating in the stock. And if you do it that way, you can afford to have not very many winners. Like, my breakdown is about 50-50. I have about 50% of the time I'm right, 50% of the time I'm wrong. It's just that when I'm right, the winners are so much bigger than the losses are, that over time it does generate a better return than it should. And so and all you have to do to be able to do it is to take that step back and buy based on what it's done historically and just kind of ignore the market a little bit. And so that's basically that's what I'm trying to achieve.
I actually have a question. I'm super happy my concussive brain works. You said something earlier in the interview, and I'm kind of fast. I'm rewinding back. You were talking about return on invested capital. One thing I struggle with the return on invested capital, like let's say we're talking about Walmart here. When you do the math to get your return on invested capital, you're getting it from the beginning of Walmart until now, right? And it kind of tends to be higher because in the past it had a huge return on invested capital, and then over time that probably shrank. But when you do you do it like a marginal return on invested capital? Like how are you doing those calculations?
Yeah, so you're always trying to the way that I think about it is you're trying to normalize through a business cycle.
Yeah.
And so I take an average of the last 5 years or so. Say, what's it earned over the last 5 years? What's been invested over the last 5 years? So what has it earned on what it has invested? So I'm looking at a more recent snapshot, not its entire history. And these businesses are, it's not clockwork. It's not a straight line. There's a lot of noise. You make an investment now, it doesn't pay off for 3 years. Bezos says their competitive advantage is they invest now for 7 years in the future. So if I'm doing a 5-year return on invested capital, I'm missing the fact that, if anything, it's under earning based on what, and that would be, you could look at Amazon, and that's been a criticism of it, that it's tended to under earn based on what the expectations were, but they're very clear. He's run it like a small business, where you're always trying to minimize tax, so you're trying to reinvest as hard as you can, as much as you can, and not show how much you're earning. You're trying to grow it. Ideally, if you're smart, you run a small business so you never make any profit because you're always reinvesting. I've not figured out how to do that, but that would be the best way to do it, right? Where you always, and there are businesses out there that allow you to. There are some businesses where you can buy an asset, depreciate it in the first year, so you don't even get the cash flow until the second. They're a nightmare to unpack from an analyst's perspective, but those are the really good businesses. Those are the ones you want to own. So, return on invested capital can be a slightly misleading metric, but it is ultimately what. So in the first 5 years of a holding of a company, it's the change in the multiple. It's the change in the multiple. It's like the change in the valuation that drives your returns. As you go along, as you extend beyond 3, 5, 7, 10 years, your return will become more like the return on invested capital of that business. Most businesses earn slightly less as they go into the future because they've saturated their market. Competition is more aware of what's going on. They're more competed against. So there's this drift down over time. Not for every business. And the sad thing is that everybody knows what all the really good businesses are. It's about 4% of businesses. We can probably, it's like Microsoft, Facebook, Google, all those really, really good businesses. They can continue to invest, and they've defied every base rate for everything that I've ever seen before. So Michael Mauboussin produces these base rates of returns on invested capital and returns based on size. These things defy all of those base rates. So that's one of the reasons that's the reason that I miss them, because they were such good businesses, such big businesses, and they were like nothing we've ever seen before. So that was a mistake that I made, but I've tried to correct for that as I've gone forward by doing various things. But basically the idea is that your own investment is going to match over time the return on invested capital of the business. So you've got to figure out how it's going to earn. And then you've got to figure out what management does with that. That's the other key. So I did 2 valuations. One valuation is assuming that there's no change in the multiple. If we own this, let's say we buy this thing at 3 times. In 5 years' time, if it's still at 3 times, what are we going to earn over that course of time? And the way that you'll earn there is whatever yield, whatever dividend or buyback is sent back to you as a shareholder, plus whatever is reinvested in the business and what that it will be worth in 5 years' time. So a 15% return on invested capital means over 5 years that they'll have deployed like more capital than is in the business at the time. So you have to trust management is going to deploy that capital sensibly over the next 5 years. And then you're going to get what they've reinvested at the end of the 5 years plus whatever they've sent back to you with no change in the multiple. And then I do another valuation that says, well, 3 times is probably too cheap for this thing. More likely it'll trade at 5 or 7 or 10 times at the end of 5 years, and then that's my upside. That's my best case scenario, that there's going to be some multiple expansion. And the mistake that I made is I used to rely more on multiple expansion than I did on the underlying quality of the business, and now I do both. I just say, if there's no multiple expansion and it still works out, then that's a good business. If there is multiple expansion, then we're going to do really, really well. But my worst case scenario is no multiple expansion.
It's similar to, well, obviously part of the reason is because of how much I've listened to you and other value guys, but it's part of how I think. Like even with Dole, actually I thought about something that it also has no debt. So that was another reason why I felt that safe. And I felt like, yes, it returns a good amount of, because it has no debt, even though it has shitty gross margins, it returns back to the shareholders. It increases its dividend. It does share buybacks, not as much, but it increases its dividend regularly. And I felt like, okay, at some point the market probably will expand this again, since it does with these other food companies are equal companies, at least. So I'm hoping eventually there's a little more positivity in the market, that will also help. I wanted to ask you. I have another question. Yeah. All right. Yeah. So here's another issue. Speaking with this friend, I spoke with this friend right before this podcast as well, too. So I'll tell you a quick story, and I think that will lead into this, right? At one point you remember when Terra Luna, you heard about this crypto thing when it went bust?
I didn't follow that closely, but I'm aware that I do know the name, and I'm aware that it went bust. That's about the extent of what I know.
Okay, so again, I'm not like a crypto guy. I have crypto because my friend had, and I got some of his, and then I bought some because he was like, I didn't know any better about anything else, and I just kept it, and I'm just kind of like, I'm just fuck it, whatever happens, happens. Or, barbell strategy. I'll focus mostly on the good stuff, and I'll leave a couple of the crazy things, and if that blows up for me, I get a black swan in that direction, positive, fantastic. If it goes to zero, I'll still survive. Not the end of the world.
Perfect.
Yeah. So, but at some point, I felt like I'm not a gambler. I've been to the casino a bunch of times. I was never the biggest fan in the world. I played roulette, didn't care. I lost money. I got annoyed. I left. I didn't like playing blackjack. I like poker kind of for the game of the probabilities in that sense, but that's it. Just the game of it, not the actual money. But he had told me, he called me at some point. He goes, man, the Terra Luna, the Terra coin, the USDT or whatever it's called. I don't know. I'm going to fuck it up. Sorry for the crypto guys. It depegged from the dollar at some point. They had basically it was like a US dollar coin. It depegged. And when it depegged from the dollar, the coin that was basically the company was making that was backing up all of this, it was all garbage. But whatever that coin was backing up, I'm not an expert on this either. It got annihilated. So everything started dropping, going to zero. And my friend called me and said, listen, I've been in the crypto game now since it started. This thing was at $80. It's trading at like 15 cents right now. At the time, it was like $1. He's like, it's going to keep dropping. But I think there's going to be whales that are going to pump. And if you want, we could ride this wave a little bit. He's like, up to you. I'm riding the wave, he told me. I'm going to ride it. If you want, he's made a bunch of money doing this. He's like, I'm going to do it. And I'm like, yeah, fuck it, whatever. I'll put a couple grand in. What's the big deal? Whatever happens. So I'm playing roulette. So I go in, I start paying. He's like, don't put it all in now. It's going to keep dropping. Put it in as it drops. And we're talking, I don't know if you've ever seen it, but crypto is insane. Like, we're talking.
Yeah, it's volatile.
It's unbelievable. So we're talking, we're at like $1. It was like $1.20. I had the first 200. He has probably like 2,000. Then it goes down to like $1. He has like $5,000. I put like 500. Then it goes to 80, all the way down to like 13 cents. And I'm adding in. And then he's like, listen, he gets to $5. He does some technical analysis, which, I don't know. I don't know what the fuck I know. I was like, bro, I'm in right now. I'm in a bit. Whatever it is, it is. So it starts flying. Boom, 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 $3. And he says, man, I think we might be able to go to $7. He goes, pull out 25% at 5. I think he's like, I'm going to keep going. Pull out 25% at 5. So it's going. He starts watching a YouTube video. By the time the YouTube video ends, it goes past the thing. I sell 25% of it. He completely loses it, and then it drops. And as it drops, I'm like, man, it's dropping quick. Should we get out like the rest of it? At least, I'm still made a ridiculous return. And he's like, I mean, I want to. And then he's like, yeah, I think you should get out. He's like, get out, man. It might get ugly. Like, he can easily afford it. I'm like, yes, this is money I can afford to lose too. He's like, yeah, but he's more wealthy than me. He's like, I could, this go to zero and my day's going to go on. I'm going to play it out. He's like, I think you should get out. And I just couldn't sell it. I couldn't. I kept clicking. I just was like, fuck it, let's just see, fuck it. And it went down to basically zero. It was like 10 cents or something. How do you ever get into worries like that when you own a security? Obviously not in that volatility, but do you ever have a stock that you're like, I'm not saying Domino's per se, that didn't happen, but if it was like a Domino's, let's say you loved it, you were in it, and it's starting to drop, when do you say, like, this is it, like, I need to get out of this? How do you resist that urge to stay in just because you're hoping for the future?
Well, so Meta's a good example of one where I think I started buying at about $150 because I thought it was worth about $300.
Yeah.
And so at $150, I bought some. And just the way that I run the portfolio, because I do all of that stuff.
Yeah.
Personally, I do all of that stuff. So I can't do that professionally, though. I can't do that when I'm running a portfolio. I have to have a better process in the portfolio. So my process is, when it's in the portfolio, it's a 3.3% position at inception. And it went from 150. It got down to 90. I can't remember exactly how many times I bought again, but it was probably I bought more 2 or 3 times, I would say. And I buy more at a rebalance state, and I just rebalance back to 3.3%. So my position, by the time it got down to 90, that's almost half. So I've probably doubled my position in it, by the time it's down to 90. And I'm always looking at, are there better opportunities around? Are there other things to do with the capital? I'm not going to sell out of it because I think it's going to keep on going down. Though. If I was looking at the valuation all the way through, they still had more users. Every time I looked, they had more users. Revenue was up. The bottom line was ugly, but I'm not a bottom line investor so much. I'm looking at, like EBITDA, EBIT, cash flows. I'm looking at what's going into the business. The criticism was Zucks were all welded into this crazy shuttle ride with Zuck off into the metaverse, and he's spending billions and big billions of dollars every year on this crazy, rocket ship ride. But you got to trust that the business can afford to lose that money. Zuck has been doing this for a long time. He's made some crazy acquisitions in the past, like Instagram. It seemed like a silly idea at the time when they said that they'd done it. I remember thinking that's dumb. I would never do anything like that. Clearly, that was a smart trade, right?
Yeah.
And you think I would learn by now, because I saw Google do it with YouTube too, and I was like, that's insane. $1 billion for YouTube is just bananas. And this was like, I was in San Francisco at the time they bought YouTube, and I was using YouTube, the very, very early version of it. My girlfriend, then my wife now, and I would didn't have a TV, we'd look on the laptop and watch YouTube videos, like what was the most popular thing. It's like, here's 30 dances or something like that. So, and they paid $1 billion for that, and I was just like, that's bananas. And of course, that was also a good trade. So I think that you have to recognize that the guys who are deep in these industries, you've got to trust that guy knows what he's doing, that he's doing good stuff in the context of what they're doing. What the investments weren't, there were a lot, but they weren't going to sink the company. And that you got to rely on the fact that he's also a pretty good businessman. At some stage, he's going to make up his mind. So as it was trading down, I was looking at the business performance and thinking, this is still a pretty good opportunity. I think it's just getting cheaper. I don't think the business is deteriorating itself. I don't think that the other opportunities out there are any better. I still think that basically that was a mind control machine that mints money that you could buy for, at one stage it got down to less than a third of what it was worth, maybe even less than that. So I was happy buying it at 90, and then it came back up, and I reversed the process on the other way. As it's going up, I'm selling and rebalancing. And so those positions, I think, on balance, they work out. I don't think that they're not all like that. Some of them go down. I sell out because I think that there's some deterioration in the business, and it's a fair reflection of what the business has done. I'm thinking about it always on a portfolio level. I've got a portfolio of 30 securities. They're all earning a lot of cash. They're all reinvesting at a high rate. They're all buying back stock at a pretty good valuation. I'm going to be wrong about some of these businesses because the future's just completely unknowable. Maybe TikTok is going to steal Facebook's lunch. I have no idea. But on balance, if you're buying this stuff cheap and you're getting good cash flows in and they're doing all the right stuff, I do think it works out over time.
Yeah, and I think that's good. Like, I felt like for me, I started, I've heard a lot of investors do this. I kind of made like a checklist, more not so much for the buying the business as much as the should I keep it, like should I sell or not? Because I realized in that experience, which that was speculative money anyway. So I knew I was gambling. It was the same as going to a casino. I got a high. It was great. It was fun times.
Yeah.
It was fun times. But I knew what that was. But now I'm like, okay, but I know that's inside me, one way or the other. And I'm like, that, as much as I would rather not admit that I would, in a more serious situation, I would be more under control. I'm not sure. I'm not 100% convinced anymore. Maybe less than I was. So one thing I did is I kind of made a checklist that's simpler. Like, here were the 5 reasons I got it. What has changed out of these 5 reasons? If it's nothing, I'm like, okay, where could I possibly, anything I missed? And I'll go and I'll look through it. And if I felt like I haven't missed anything, it's past the 5 checklists. I still obviously could be extremely wrong, and it'd be, I probably am, but that's why I position everything a little bit smaller than I used to now, because I just get that it's possible. Then I won't make I won't make those mistakes of either getting too attached to what's happening with the price, either the gambler's high, or even the gambler's not sell, because I think that it's almost a similar level of gambling. Like when you're losing, you can't stop. That's one of the main signs of a real gambler. It's like it's when you're losing and you can't be like, nah, I'm not playing roulette no more. You got to keep it in there. You keep it in there. And I was like, that's a bad sign.
There's this game in Australia called 2-Up, which you play on Anzac Day, which is like Veterans Day.
Okay.
And it's a gambling game where you flip 2 coins and you call the outcome of the coins. Like, it's pure gambling. There's no skill in it whatsoever. And the way that you do it is you stand in a big ring and you hold out money. Like, you say, I want to bet 5 or 20 or 50 or 100. And then you find someone on the other side who wants to take the other side of your bet. So you say, I've got $50 on 2 heads, and then you find someone who's got $50 on 2 tails, and you just match. And that's how the deal. And so I forget who holds the money, but it's one of the person whose tails or heads, or somebody holds the money. Like, there's a rule for that as well. And I've played that on Anzac Days, and I've had these great runs playing it. Like, it's pure luck.
Yeah.
There's no skill in it whatsoever. But I had this run where the other guy got upset and he wanted to keep on doubling up. And we doubled 2 or 3 times, and it got to the point where it was like he was risking something like, I can't remember exactly, but he's risking 500 to get back 50, basically. And I'm up 450 to lose, so I don't care because it's all fun. And I'm saying to myself, this is just fun, man. And I won.
Yeah.
And then I got this, and I was at that point that I had this, like, I distinctly remember I had all of those feelings, like, you're full of adrenaline and you're full of, like, good feelings. And I was like, I have to go for a walk around the block now because there's all of these people and everybody's cheering. Yeah. And when you win, it's like everybody thinks it's like you've done something. And I distinctly remember, like, this is what it's like to gamble and to win. And this is the addictive high that people love. And I thought, if I don't go for a walk now and, like, break this pattern, if I don't go for a walk around the block, I'll just vaporize all of my money here. So I walked away and I came back and I just stood outside the ring and watched for a while. And as I was standing outside the ring, I could see everybody in the ring having those same feelings that I was having. And I just thought it's such a trap. Because I don't like gambling for that reason. For the reason that I like it so much.
Yes.
Do you know what I mean?
Or,
It's addictive.
it's very addictive. It's funny that I remember. So at some point when I first started the fund with my clients, like the first few months, I was tracking my performance on Interactive Broker versus the S&P 500, and I was telling my friend, who's like, I'm like, man, I'm doing better than the index. It's almost the first quarter. I'm gonna send a report. I was getting all excited. He was like, listen, man, I don't know about stock investing, but I've been in the game of investing, even if you call it speculating, for years.
Yeah.
If you get attached to these winnings, you're going to feel like dog shit when you lose, and it's going to completely ruin all your methodology, and you have to have a strategy to be able to stick to it. And he was so much wiser than me at that point, because I was like, oh, I'm not stuck to it. I'm just looking at it. I'm just tracking it. And I remember the day that my performance dipped under, and I was like, oh my God, I feel like I got hit by a bus. Like how am I going to tell my clients? What am I doing? Obviously, this was the biggest mistake. How the fuck did I think I could do this? You're a professional fighter. You never did a fucking accounting class in your life. Oh, you're ridiculous. Well, obviously, this was the dumbest thing ever. Well, fucking good idea, genius, the whole 9 yards. And then when I told my friend, he's like, take it easy, bro. He's like, tell me why you bought. And I explained why I bought what I had bought. And he's like, okay, what did change? And that's basically how I kind of started coming up with the checklist. And then I remember when it went up back and I started outperforming, and I've been outperforming since, I keep telling myself, like, doesn't mean shit. Like, this is pure chance. It's just chance. In 10 years from now,
it's more than chance, though.
Yeah,
it is more than chance.
Yeah.
No, you're right. Short term, it's all noise. Yeah. But over time, it should be more. It should be performance. There's a great line from John Maynard Keynes. I think it's in the General Theory, and he says something like, "To those who don't have the gambling instinct, investing is intolerably boring.
Yeah.
But if you do have it, you've got to pay the appropriate toll." Like, to those who do have the propensity, you have to pay the toll.
That's beautiful.
And that's the way I think about it too. Just like if you don't like making money and you don't get into it, there's just no reason. It's just boring as hell. Mm. But if you do like it, there's a cost, and the cost is that you get those good feelings, you get those bad feelings. And I've been doing it for long enough now that I remember the first time I ever bought a stock. Like, I had the blood rushing in my ears. I had the full on like gambling like instinct, like, goose pimples standing up and sweating, and like, it's so silly. Now I've been doing it for long enough that it's all processed now. I know that the things that will trigger me into that hot state, and I just don't get into them. Having said that, like, I had a nice run on the funds from like October. Zig has been my main fund has been underperforming for a variety of reasons. Part of it is the cycle. For me to start working, I need a crash, and it's an early cycle strategy value for the most part. And I know that I have a little edge, and over time that will work its way out. And so I'm not too worried about it. But, when it does start up, I can say that to you now in this cold state.
Yeah.
But like from October to February 2nd, I know the dates that like it was running. It was all running with me. And I was feeling so good, and I was just like, nothing matters. I'm just walking around. Something happens at home, and I'm just like, don't worry about it. It all just figures itself out. I was saying it to my wife, and then the moment the performance dips after February 2nd relative to the market, my wife, like everything changes. I'm like, fuck this shit. This is just, it's not fair, And she's like, I got to get you exercise. I got to get the demon out. Like, it's hard, dude. It's just, I don't think you ever get over it. I don't know how, like Buffett, maybe he's at 90 years old. He's just seen so many cycles, and he's so far ahead. It doesn't bother him anymore. But I'll bet the little mistakes that he makes, like IBM, I bet you that irks him just a little bit. He's just like, God damn.
I was thinking that it must. Like, I was watching Smith's Fund's annual. They had it was like their annual meeting or something, and I was watching him, and he was so smooth about like his underperformance. He was like, we've done this, but we got these great companies, and he was just kind of chilled, and he has a nice swagger about him too, and he's like smooth talking. And I'm like, man, this guy, does he have ice in his veins? I was thinking, there's no way he has to like before he gets on stage. Like, there's no way you're this cool. Yeah,
Just has a Valium before he gets out.
Yeah, exactly. He was just like, a free cash flow yield is this and this. I was like, bro, how you're telling all your investors this right now? How are you not freaking out?
It's a tough game. It's a mentally tough game. And it just gets to, like you say, it just gets to all of the insecurities that you have. Like, is there did I not do enough work? Has everything changed? Am I not smart enough? Just like the list of stuff. I always say that the stock market is one of the best tools at revealing whatever psychopathology you have inside of you. Like, what is the thing that you're most scared of? The stock market's going to show it to you in yourself. Like, what's the thing you're most scared of in yourself? Yeah. What's the insecurity in yourself? You're going to find out in the stock market or any kind of gambling thing. It just does it to you. And overcoming it is like the single most important thing.
Yeah, and that's something I've been. That is, if I have to say, is my. If I've learned, I'm trying to learn. I'm still super trying to learn as much as possible. I consider myself new.
Me too. Me too. I mean, I've been doing this for a long time. I'm early in it too. I feel the same way.
I don't. There's never. Like, if you ask my wife, there's never a moment that I'm not listening to a podcast. I'm not reading a book about it. I'm not. I'm not trying to read some kind of about business generally. Like, I even try to I've gotten into now looking up, because I'm opening a small business. I'm opening a gym in Miami. Quick plug for their fight sports. I've been looking into buying small businesses and seeing how they think about it, and think like, oh, this might be a way to, weave into investing into these larger companies. But still, I'm constantly, I think the hardest thing for me to do is to convince myself that this is I just have to build the process, because I'll just constantly come back to thinking oh man, you were in the D group in math class. What the fuck are you doing? You were too busy thinking about what the girl next to you was doing. You had no idea what was happening in class. And even if you did, you might not have been any good at it. You never tested it, You didn't even go to college. I start having these thoughts going through.
Yeah, I understand that completely, and I think the only thing that you can do to get over it is to build a better process and just keep on working on the process. And I don't think that ever ends. I think you just got to keep, there's not a day goes by that I don't learn something new when I'm doing this stuff. I listened to Buffett this morning when he was talking about, he bought the 5 Japanese trading conglomerates, because he says they're a lot like Berkshire. And he said, I think, and you can listen to the way he says it. He was like, he has this, I think I understand the business. He was kind of I think I understand what they do. And I was like, that's interesting. He wasn't just telling anybody, yeah, I know what they do. He was like, I think I understand what they do.
I think I got him. I think I know what's up.
Yeah. But I thought that was a little tell. He was he's not certain. He's still, even at 90, whatever, he's still uncertain about it. And I thought that's good to know. We're all in that boat. Yeah.
It's great to hear. I love it. I listen to the Acquirers podcast regularly, and because you guys talk so casually on it, I'm always okay, man, look, they're confused too. They're probably a lot smarter than me, and they're figuring out, they're making mistakes left and right and talking about it, and I'm okay, I'm not alone in this boat, I'm not the wrong guy out there.
People who say that they know what they're doing are the only ones that you know who don't know what they're doing. If you're not confused, then you don't know what you're looking at, because it's always changing, for one thing. Businesses are changing, the cycle's changing, the opportunity set's changing. You're always scrambling to catch up with what's going on. And the biggest risk that you're going to have is that you just get certain about something and you're wrong. So you want to be always, I think you want to be uncertain. That's the best place to be.
Tobias, I got one more question, and I'm going to let you go because we're going on an hour. I don't want to keep you anymore. I've been taking up a bunch of your time, and you're doing a second podcast for me, so I'm going over and above. I'm taking all my advantage here. A real dick. But, yeah, no, I have one more question that I have for you. That I was thinking, what's your opinion on this? I wanted to ask somebody that knows more about investing than I do. I've been reading about a potential index bubble. People are worried that there's an index bubble. And, Buffett and many investors have recommended to retail investors and to people that this is what you need to do. Just invest in the S&P 500, go to sleep, and, dollar cost average your way to the top. Do you think there's a risk of this strategy becoming overpopular, overcrowded, and us actually being in an index bubble?
When you look at the indexes, they are expensive on long-term measures like Shiller PE, or that's a cyclical PE, which takes a 10-year average inflation-adjusted earnings and compares it to the current price. And the reason you take an average of inflation-adjusted earnings is it eliminates the business cycle. And so when you look at the single-year PE, you get a problem where in 2008 there was no earnings because the banks lost so much money, they were zeros in terms of earnings, wiped out the earnings for everybody. So there was infinite PE, one of the best times to buy ever. So it was a misleading multiple then. So the Shiller PE just smooths for that. You get the same. It's saying that we're 60 or 70% overvalued. You get the same answer if you look at Tobin's Q, which is replacement value of assets against market value of assets. You get the same answer if you look at total market capitalization to gross national product, which is Buffett's favorite measure. That just says what's every single company resident in the US earning relative to what you're paying for all of that kind of equity as a whole. They all indicate that we're very overvalued. The reason Buffett says to the last time we were like that, say 2000, we spent 10 or 15 years going sideways on an index. So it just didn't go anywhere for a long period of time. You still got dividends and things, but the index kind of sunk, and there were two big crashes. There was the 2000 crash, there was the 2009 crash. So from that perspective, I think we are overvalued. Is that a bubble? I don't know, but it's probably... The returns for the next 10 years look nothing like the returns for the last 10 years because we've maxed out on margins are higher than they've ever been, multiples are higher than they've ever been. Companies are bought back all of their stock and they're heavily indebted. So probably anemic returns for the index with probably a lot of volatility in between. I think that's what's going to happen. Having said that, the reason that Buffett says to invest in the index, while you might not get a great return over the next 10 or 15 years, there's no risk of a donut there, because the index itself is built in such a way that it's always readjusting. They're holding the biggest companies, and that's what hurts their returns. But it also means that as they readjust and they keep on holding these companies, the risk of a zero there is low. Like you could have a big drawdown. You could lose 50% of what you've got in those things. Like that's entirely possible. That happens all the time in the markets, and you should be cognizant. You should be thinking about that possibility. But they'll reconstitute it and they'll keep on reconstituting it. And so those indexes won't ever be donuts. You can put family wealth into them, and in the next generation, it'll still be there. And the index reconstitutes because a committee does it, and you don't have to do anything. You can just keep on investing into it. The worst case scenario is you don't make much money, or you get a 50% haircut in the short term. But over the longer term, anemic returns, but then beyond that, the longer you hold, the more your returns will start to look like the underlying businesses. So I think that the two things are true. It is likely that we're in an overvalued period, but it's also true that if you're not a stock market person and you're not in the market and you're not watching it all the time, and your holding period is long, like mine is, like yours is, that's a better alternative than not being invested in them, provided that you're saying to yourself, I can take a big drawdown and I'm going to be consistently investing and saving for the next 10 or 15 or 20 or 25 or 30 years. You're much better off putting it into the market than keeping it in cash. Like that's a disastrous idea. Or putting it in bonds, that's a bad idea. Inflation will eat it all. So that's how I square the two. If you're in the market, you can do better. If you can value stuff, you can do better. That's the way that you should be going about it. If you're not going to do that stuff, stick it in an index.
Tobias, this has been super fun, super entertaining. I really appreciate you coming on, especially for a second time. So far, I haven't seen no red flags popping, so I'm hoping that this came out perfect. Thanks again. Guys, I super recommend the Acquirers podcast, and Tobias does a shit ton of podcasts. And I try to listen to as many as I can. He did one with 7investing.com.
Yeah, with Matt Cochran.
It was fantastic. I actually was watching clips of it before we jumped on because I didn't want to try to re-ask too many of the same questions. But it was awesome. You guys need to keep listening to him. Buy his books. I'm buying more and more of them. Again, thanks to Tobias, and hopefully I'll see you in LA.
Hey, thanks, Tony. That was fun. Yeah, I look forward to it.
I appreciate it.